What the hell is blended finance? Blended finance usually refers to the more traditional side of this blended and innovative finance sector. It addresses a lot of the de-risking issues. So here, the definition pulled up by Convergence is that blended finance is the use of catalytic capital from public philanthropic sources to increase private sector investment in developing countries and sustainable development. That's a lot of words. And so let me try to explain this in plain English. This is also a wonderful graph that Convergence drew up. Basically, you have development funding from public and philanthropic funders. What they're trying to do is, instead of putting it directly into a project, they put it in blended finance structures at a concessional rate. Concessional rate meaning that they're not going above and beyond to create profit out of that, but rather they accept, okay, you know what, I can, not make too much money out of it, that's fine by me. And by doing that, they're mobilizing private capital that's always looking for market rate return. So they make sure that instead of just using their $100, they're drawing in maybe $400, $500 more, where they're looking for market rate return into this blended finance structure. And then suddenly the project becomes much more bigger, and you supposedly can have so much more impact with that much more money. So this is a little bit how it works in plain English. And the features of it is that it always expects a positive financial return. So it's not philanthropy, it's not charity, and it contributes towards achieving the SDGs. So this is a bit of a difference between, some of you might have heard PPP or public-private partnerships that are more or less a similar structure, but they don't necessarily target SDGs. You also have public or philanthropic parties as catalytic capital. So they improve the risk-return profile to attract participation from the private sector, like explained. This can take many different forms, and I'm not going to go into details about this. Convergence in their report actually explains this quite well, but just briefly, it can take the form of concessional debt or equity, which means basically the philanthropic or public organization takes the first hit when shit hits the fan. They can also offer guarantees or risk insurance. For instance, if commercial investors are a bit iffy, but what if we lose a lot of capital? Then this philanthropic organization would say, let me guarantee you up to 60% of your losses covered by us, for instance. Oh, you think there's a lot of capital risk? Well, there's this wonderful political risk. Well, there's this wonderful political risk insurance that we can offer. Things like that. So suddenly a commercial investor who thought, but there's too much risk involved, says, actually with insurance and guarantees, this is a risk I can accept. So, it goes a bit like that. It takes many different forms, and they can also be used in combinations. Main point being that these are de-risking mechanisms. So the benefit of this structure is that, first of all, diversification. So this structure usually has a portfolio approach. It's very, very rare that within a single project financing, you would blend capital. Usually you have a big pot of public funding and a big pot of commercial funding that jumps into one big pot of capital. And then this capital is distributed by experts, so either through a fund or asset managers. And this helps that, for instance, if suddenly there's a coup in Malawi, that region, it doesn't look very good, we'll have losses there, but because you've invested in so many other regions as well, that it's going to be fine. Or if suddenly the renewable energy sector goes bust for whatever reason, then because you've invested in other sectors as well through this massive basket, that it's fine. So this portfolio approach, basic diversification, guarantees a certain amount of low risk. Another thing is, okay, it improves the risk profile, not the same way as diversification, but in the sense that, you know, you have a super impactful project, and through guarantees, through insurance, through these first hit loss, things like that, you basically have this project move in this direction and sit here. So that's a little bit how it works. So these are the benefits, but what's the catch? Well, one of the catches is that it's very difficult for a blended finance structure to prove that it has additionality. So additionality being, you want to give money where it's needed most. So if you have to give water, you want to give it on the left region, right? You don't want to give water to this right-hand side where you have plenty of water lying around. So it's the same concept. You don't want to give money to where money is already plenty available. You want to give money where it's most needed. But sometimes with blended finance, it's difficult to prove that you're giving it exactly to where it's needed, and things wouldn't have happened without this financing. It's also not necessarily required and measured up to this point. So that's a bit of a problem. You have cases where, for instance, a lot of development agencies went in there and wanted to provide a lot of capital for microfinance. The problem is there were already a lot of commercial investors who were offering microfinance services, and by these development agencies offering tons of money, well, people who shouldn't have gotten credits were starting to get credits, so they were all over indebted, and this is sometimes what happens. Another catch is that it's not always aligned with impact. So you're giving capital to with the hopes that this person will, or this manager or whomever's in charge, will invest to grow enterprises and projects that are of impact. And your premises and assumptions are that the more this enterprise grows, the more impact it will have. But this is not always true, because we all know that sometimes with growth, you have a bit of a mission drift. So you're targeting more and more, instead of the bottom of the pyramid, you're starting to target more and more middle class, mid-sized cities. You're going more for where the money is and not necessarily where the impact is, because you have pressure from investors and they want to see you grow. And they want to see you grow. Why? Because they want you to have more impact, but somehow these two things are not always aligned. And blended finance doesn't really help with that alignment. It just provides more capital. So these are some catches that you need to be aware of when you're using this particular instrument.